Welcome to Iron Financial. I'm your lead analyst, and my mission here is simple: to help you forge a stronger portfolio, cut through the noise and market weakness, and find the true structural integrity in today's leading equities. Listen, with interest rates acting like an absolute vice grip on auto loans right now, pretty much every legacy automaker out there is feeling the squeeze. So today, we are putting General Motors under the microscope in our signature Iron Drill Down. We're tearing down their Q1 2026 earnings report to see if the foundation of this company is built on solid steel or if it's just being propped up by temporary scaffolding.
And I'm the market skeptic. My job is to ask the hard, uncomfortable questions you're probably screaming at your screen right now. We're all seeing the flashy headlines. The media is going crazy about GM surging on this massive earnings beat. But look, we know better than just trust the shiny blueprint without physically inspecting the job site ourselves. We need to know, is this hype or is it real? Are we looking at actual, durable, long-term strength or just a fresh coat of paint over a crumbling foundation?
That brings us to the core question of today's explainer. GM's Q1 beat, solid foundation, or is this just a paper tiger? Wall Street is out there popping champagne over the headline numbers, but you and I both know that the devil is always in the details. We're currently operating in a highly volatile macroeconomic environment. We're talking about lingering supply chain hangovers, incredibly persistent inflation, and an EV market that frankly seems to be cooling off for the broader consumer base. When a legacy automaker posts a massive earnings beat against those kinds of headwinds, we have to aggressively stress test every single load-bearing pillar of that report.
Exactly. We don't just look at the finished skyscraper. We look at the rebar holding the whole thing together. We are going to rip into the revenue, the debt, the cash flow, and the operating margins today. We want to know if the underlying business model is actually generating pure horsepower or if clever financial engineering and one-off accounting events are doing all the heavy lifting. Let's start the iron drill down and look at the actuals versus Wall Street's estimates.
Let's lay out the foundational data on an adjusted basis, meaning we are stripping out the one-time accounting noise to try and see the raw operating truth. GM delivered a massive non-GAAP earnings per share of $3.70. That completely shattered the consensus estimate of just $2.69. That is serious structural reinforcement on the bottom line. But you have to look closely at the top line. They brought in $43.6 billion in revenue, which actually missed the consensus forecast of $44.99 billion. More importantly, it was down 0.9% compared to the $44.02 billion they pulled in during Q1 of last year.
Hold on a second, lead analyst. This right here is exactly why we do the teardown. How in the world do you construct a massive, structurally sound profit beat when your top-line revenue is actually shrinking? You're telling me fewer total dollars came in the factory doors, but somehow way more dollars magically made it to the bottom line. That usually implies incredibly aggressive cutting costs or something else entirely artificially padding those profits, which naturally brings us to the cash flow, where, honestly, I'm seeing some massive glaring cracks in the armor.
Look at the clash in these cash flow metrics. Adjusted automotive free cash flow is up 56.4% year over year to $1.269 billion. Now, that sounds fantastic to the retail investor, right? But then look at the true, unadjusted engine of the business, automotive operating cash flow. It absolutely plummeted by 77.8%, dropping from over $2.4 billion last year down to just $533 million. You cannot forge a stronger portfolio by ignoring a nearly 78% drop in core operating cash.
It's a harsh metric, Skeptic, and it definitely tests the company's financial foundation. Look, operating cash flow is the raw, pure cash generated by GM's everyday fundamental business of building and selling cars. When that drops by nearly $1.9 billion in a single quarter, it means the core machinery is bleeding cash compared to last year. Now, why did free cash flow surge while operating cash flow tanked? It really comes down to timing. You can temporarily make free cash flow look pretty by aggressively altering your working capital, delaying payments to suppliers, or holding off on massive factory capital expenditures. But that drop in operating cash shows the core engine is definitely struggling. And speaking of things artificially propping up the numbers, we need to talk about a very specific $500 million tailwind.
$500 million. That is the massive one-time structural support GM received this quarter. The company announced a favorable adjustment of approximately $500 million resulting from a U.S. Supreme Court decision. This was related to certain U.S. tariffs that GM had previously paid under the International Emergency Economic Powers Act. There it is. The truth finally comes out. So that massive EPS beat wasn't entirely forged on the factory floor. A huge chunk of it was won in a courtroom. I mean, are we investing in a car company or a law firm here? Now, I'm not knocking a legal victory. Cash is cash, and it absolutely bolsters the balance sheet. But as investors, we have to separate repeatable operational strength from one-time legal windfalls. If you strip away that $500 million Supreme Court refund, does the Q1 earnings foundation still hold up its own weight? Or does the whole narrative just collapse? It's a completely fair question, but we have to look at how this legal win structurally alters their blueprint for the rest of the year. This wasn't just a retroactive refund check. It permanently changed their forward-looking cost structure. These tariffs were heavily tied to raw materials and imported components, things like specialized steel, aluminum, and critical electronics. Because of this ruling, GM now expects gross tariff costs for 2026 to be between $2.5 billion and $3.5 billion. That is down significantly from their original estimate of $3.0 to $4.0 billion. It fundamentally lowers the cost to build each vehicle moving forward.
Okay, so they essentially get a permanent reduction in their materials cost overhead. I'll admit, that does provide some solid, tangible scaffolding for their full-year outlook, especially despite all the macro uncertainty and supply chain snags they're facing right now. It gives them a much wider margin of error if consumer demand softens further. Let's see exactly how they welded this new cost structure into their updated 2026 guidance.
Here is the updated architectural blueprint for 2026. GM raised its full-year EBIT-adjusted guidance to a range of $13.5 billion to $15.5 billion, which is up $500 million from the previous range. They also hiked the adjusted diluted EPS target to between $11.50 and $13.50. This signals serious management confidence in their ability to drive profitability.
But look at the automotive operating cash flow target. I am pounding the table on this one. They quietly lowered it. It was $19.0 to $23.0 billion, and now it's down to $16.8 to $20.8 billion. They essentially shaved over $2 billion off their expected cash generation from core operations. You can't just hike your adjusted earnings while simultaneously downgrading the actual cash coming in the door and expect me not to call it out as a major red flag.
To be fair, management argues they are building in a conservative cash flow buffer. They are planning massive factory retooling for new EV lines and deliberately building up inventory to avoid future supply shocks. Yes, it eats cash now, but they claim it builds a stronger foundation for later. Let's look closer at the profitability metrics to understand the full dynamic here. The structural strength here is absolutely in the margins. The EBIT-adjusted margin, which is earnings before interest and taxes, jumped by 1.8 percentage points to 9.7%, up from 7.9% last year. In terms of absolute percentage growth, the EBIT-adjusted margin itself saw a 22.8% relative jump. That means for every dollar of revenue coming in, the actual factory operations are retaining significantly more profit.
Okay, but then explain the drop in overall net income. Overall net income attributable to stockholders actually dropped 5.7% year over year, landing at $2.6 billion, down from nearly $2.8 billion last year. If operating margins are supposedly so great, why did the actual bottom line fall?
That is exactly where the macro environment bites back. EBIT strips out interest and taxes to show pure operational efficiency. Yes, they ran the factories better and cut operational fat, but GM's actual real-world debt servicing costs, thanks to those sky-high interest rates we talked about, along with higher tax obligations, severely squeezed the final check they deposited in the bank. The core business is leaner, yes, but the macroeconomic gravity is still pulling down net income. Now, while overall net income contracted, you have to look at their absolute strongest pillar right now, North America. In Q1, GM North America delivered an EBIT-adjusted profit of $3.66 billion. That resulted in a stellar North American margin of 10.1%. Now, to stress test this fairly and address your skepticism directly, GM explicitly noted that this 10.1% margin includes a 1.5 percentage point benefit straight from that Supreme Court tariff adjustment we discussed earlier. So, without the Supreme Court stepping in to save the day, that North American margin would be sitting at 8.6%. Still respectable, sure, but it proves my point that the legal win is carrying a massive amount of the weight here. However, GM did state they are still firmly on track to achieve their 8 to 10% full-year margin target regardless of the one-offs. If they can maintain that 8.6% baseline purely on operational merit without the one-time legal help, the domestic foundation might actually be solid steel. Let's pivot to future growth and look at where they are laying down entirely new foundation: electric vehicles. While EV adoption is definitely facing headwinds in the US, the heavy lifting is happening up north. In Q1 2026, General Motors remained Canada's absolute EV sales leader. Their EV sales increased 13.1% year over year. They captured close to a 20% total EV market share in the country. And look at Cadillac. It is absolutely dominating, capturing 50.6% of the entire Canadian luxury EV segment. The top 3 selling luxury EVs nationwide were all Cadillacs: the Optiq, the Lyriq, and the Vistique. They are winning because their Ultium battery platform is finally scaling effectively, allowing them to offer localized, competitive pricing that their rivals just can't match right now.
I have to admit, capturing over half of an entire country's luxury EV market is legitimately impressive. It shows that their multi-billion-dollar bet on the Ultium platform is finally bearing real structural weight.
But I still have to ask the hard question when I read this quote from Shane Pever, their VP of Sales. He mentions attracting customers with the broadest lineup, but the official release also explicitly notes this is supported by new federal incentives that make EVs more attainable. So is this Canadian dominance a genuine indicator of North American EV durability, or is it just a localized, temporary win propped up by government subsidy scaffolding? If those incentives vanish tomorrow, does that 20% market share immediately crumble to dust?
It's a risk factor you must continuously monitor. Incentives always distort early-stage markets. However, look at exactly where they are winning. The luxury segment. Capturing 50.6% of the luxury market suggests genuine brand traction. A $5,000 tax rebate doesn't make or break a $90,000 Cadillac purchase the way it dictates a mass-market compact car purchase. Luxury buyers are far less sensitive to marginal rebates. GM is building a real structural brand advantage in EV market share, while their competitors are terrified and pulling back.
And while they build out that EV future, they are aggressively returning capital to the builders, the shareholders. GM declared a $0.18 per share quarterly dividend payable on June 18th. But the real structural reinforcement is in the buybacks. They repurchased $0.8 billion of shares in Q1 alone, completely retiring 10.7 million shares from the float. They still have a massive $5.5 billion remaining on their share repurchase authorization, and they can easily afford it, ending Q1 with an impenetrable, fortress-like automotive cash balance of over $19 billion.
I can't argue with $19 billion in cold hard cash. That is the ultimate concrete foundation. It means that even with operating cash flow taking a massive 78% hit this quarter, they have an impenetrable balance sheet to absorb the shock.
But let's be crystal clear on those buybacks for the audience. Retiring 10.7 billion shares artificially boosts that $3.70 EPS number we talked about earlier. Think of it like a pizza. If the company buys back and destroys 2 slices, the remaining slices technically represent a larger percentage of the total pie. The total profit, the physical size of the pizza, might stay exactly the same, but your earnings per share goes up. It is incredibly smart financial engineering that directly benefits the shareholder, but we have to remember it is engineering nonetheless. So let's bring it all together for the final iron drill-down verdict. Is GM an opportunity or a trap? The opportunity case is forged in pure steel. A massive 3.70 EPS beat, raised full-year EBIT guidance of up to $15.5 billion, showing massive operational confidence. A dominant and growing EV market share up north. A $19 billion cash fortress, and relentless share buybacks that actively increase your ownership stake every single quarter. But on the other side, the trap case highlights severe cracks in the foundation. A horrifying 77.8% drop in pure automotive operating cash flow. A top-line revenue miss that proves the core sales engine is slightly decelerating in a tough macro climate. A deliberately lowered full-year operating cash flow forecast. And a Q1 margin and EPS story that is heavily reliant on a one-time $500 million Supreme Court tariff refund. You have to decide which side of the ledger holds more weight for your portfolio's structural integrity. And that brings us to the final stress test. Wall Street expects GM to accelerate significantly in the next quarter, with Q2 revenue estimates sitting at $48.79 billion and EPS projected at $3.38. That means the heavy lifting is only going to get harder from here. They won't have a $500 million surprise refund from a judge to pad the numbers next time around.
Exactly. They have to prove that the core factory engine can generate pure operating cash flow to match those pristine adjusted earnings. When Q2 drops, the absolute first metric you need to look at is that unadjusted automotive operating cash flow. If it's still bleeding, the foundation is weak. So we turn the question over to the Iron Financial audience. Looking at the blueprint, the reinforced margins, and the undeniable cracks in the cash flow, are you forging a position in General Motors? Are you staying safely on the sidelines until the foundation settles? Do your own stress tests, assess your portfolio structural integrity, and keep forging ahead.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.